on behalf of CNBC TV18, thank you so much to each and every one of you for joining us today, for your support over the last 25 years, and we look forward to many, many more. Thank you, ladies and gentlemen. Without further ado, to kick things off, mapping the macros, Samiran Chakraborty, the stage is all yours. A big round of applause for Samiran Chakraborty.
Thanks, Shireen, and thank you, CNBC, for giving me this opportunity. Am I audible? Yes. You know, at times when the markets are doing so well, the demand for economists typically come down. We have a demand curve which is inversely proportional to the markets. So I'm just wondering why even CNBC gave me this opportunity to speak today. We are in high demand when the economy is not doing well. But today is a time when I'm going to just simply, that's why I choose 4 random questions. And I will try to give you my version of answers to those 4 questions, because I think most investors are asking me these questions. So let me first put the questions in front of you just to whet the appetite. So the first question is that the way the global economy is shaping up, is it a tailwind for India or is it a headwind for India? The second question that I want to attempt is India's growth too hot or too cold? The third question I'm going to attempt to answer is that would RBI cut interest rates at all? Why? And the fourth question is that, and this is something which just happened today, that at a day when equity markets touched an all-time high, why is it that the currency touched an all-time low? So over the next 20 minutes or so, I'll try to delve into these 4 issues. So first, on global. Look, just a few months back, I used to say that everything around global is turning out to be good for India. Now, it's a bit mixed. So what is good is that global growth is not falling off the cliff, as a lot of people would have worried. Even in Citi, our house view was of a very slow global growth year of less than 2% global GDP growth. We have upgraded that a bit. The second factor that was a big positive to start with was that interest rates globally would be cut significantly. The market expectation was that Fed will cut about 125 basis points or so. Now, it appears that because of the slightly higher growth and slightly more resilient inflation numbers, the expectation of interest rate cuts have come off. The market expectation is about 75 basis point rate cut, but for all practical purposes, now people are confused when and how much rate cuts are going to happen. But apart from these two, the most important thing for India has always been commodity prices, particularly oil. And this is the new development which is slowly being baked into markets, that oil prices has creeped up to $90 per barrel. I am no expert on geopolitics to tell you exactly where oil prices are headed. In fact, in Citi, our house view is that oil prices will come off from these levels. But just in case oil prices go up, let me give you the sensitivity of India's macro to oil prices. So the sensitivity is that about 10% increase in oil prices leads to about 15 basis point decline in India's GDP growth, and about 30 basis point increase in India's inflation, and about 0.4% of GDP increase in India's current account deficit. These numbers are not scary, particularly given that we are starting off from a very stable macro and growth environment. But the big but is that globally, the favorite trade for investors is to short Indian assets whenever oil prices go up. This is an instinctive reaction. And I'm worried that when a particular threshold of oil prices are reached, there could be some negative effect on investor sentiment regarding India, not as much a worry on the macro factors of oil price impact. I will not have time to delve on two issues globally, but I think from a medium-term perspective, which we have to be worried about, which is that how this huge increase in global public debt is going to be unwound and how emerging markets would be impacted by that. And the second issue is connected to it is about global liquidity. In my view, global liquidity is still very ample, flush. When this liquidity is tightened, how that impacts EM assets is something also we need to understand. So that's broadly the global backdrop. If I quickly move on to the second issue of is India's growth too hot or too cold, the debate starts from these two concepts that economists use of GVA and GDP. As you know by now that our GVA growth is around 6.5, and our GDP growth is around 8.5, and everyone is scratching their head to figure out how this 200 basis point of gap can be explained. I think it's a useless debate. Economists will like the GVA number because that's how the data is collected. But it's also true that for years together, we have been using the GDP growth number for policy making, for our commentary, everything. So just because the GVA number today is what fits our perception does not mean that we can change the metric and move everything to GVA. So I suspect that policy making will keep on happening on the basis of the GDP number, not on the basis of the GVA number. But even if we believe the GDP number, it's quite true that it's a two-paced economy. Two-paced because the investment side of the economy is doing significantly better than the consumption side of the economy. Investment is growing at double digits for 3 consecutive years, which has never happened in India's history. And consumption is the weakest that we have ever seen barring crisis periods. I have a strong suspicion that the consumption numbers finally will be revised upwards, but be that what it may, there is still going to be a gap. The issue, and Shireen mentioned this, that whether India's growth will be consumption-driven or investment-driven. If you look at last 2 decades of India's strong growth, consumption used to provide 400 basis points of GDP growth on an average every year. So if investment was growing at 8-10%, we would easily get 7-8% growth. So it's important for consumption to come back to that level of 400 basis point contribution to GDP growth. So the optimistic spin to this is that the investment growth that we are seeing now, that will create the jobs, the income, and the demand and the consumption with a time lag. The pessimistic story is that if demand is not picking up, then ultimately the investment side will also suffer, private capex growth will not happen. And that leads me to the investment side itself, where there is a two-pace. Two-pace because the perception is that public capex is driving the entire investment growth and not private capex. When will private capex pick up? But interestingly, if you break the investment data, only 25% of investment comes out of public capex. 35% of investment is private capex, and 40%, the largest part of investment, is actually household capex. And household capex, in turn, is mostly real estate. I would argue that the public capex and the household capex is what is driving our investment growth now, with some support from private capex. But over a longer term, my sense is that we will not go back to the 38-39% investment to GDP that we had seen in the past. We are utilizing sweating capital much better than what we were able to do. Our productivity is much better. So even with somewhere around 35-36% investment to GDP, we should be able to generate the right kind of growth for us. And then lastly, within consumption, there is also a view that there is a K-shaped consumption. The top-end consumption is growing better, the bottom end is not as much. I suspect what is going on here is that the cumulative inflation over the last 4 years have been more than 30%. So people who have got income growth of more than 30% are able to cling on to the consumption basket, grow their consumption. But people who have not got that kind of income growth, that's where the consumption growth might have suffered. There is one trivial way of presenting this through urban versus rural. I'm generally not too much in favor of that. In India, it's difficult to break this up in a watertight way. But going forward, our sense is that there are some headwinds developing on the urban consumption front, where there are some tailwinds developing on rural consumption. So maybe this gap will converge as we move forward. But overall, if you look at it, the RBI is most likely to increase their growth forecast for next year. Would probably be around 7.5% growth next year. But the big question, and I'm not going to give an answer to this question as such, but just put it up in front of you, is that should we be happy with 7% growth? Why? Because of this unique conundrum that we have now, that given our demographic dividend, which is going to last, in our view, for a decade, should we be aspiring to grow at closer to 10% to get the maximum advantage of this demographic dividend? Or should we be looking at the global growth at 2-3% and say that in this turbulent period, if we can get even 7%, 7.5% growth, that's good enough? I think depending upon which view you take, the direction of policy could be very different. You would have to be much more radical in your policy thinking if you aspire to grow at 9-10%. 7%, 8% growth is a very conservative policy approach, according to me. Let me quickly move on to the third topic, which is, should RBI cut? Again, there are three aspects of rate decision. One comes from growth, one comes from inflation, one comes from financial stability. As we were just arguing, India's growth is more or less fine right now. There's no need or urgency to cut rates for supporting growth, unless you believe in my thesis that India needs to grow at 9-10%. So a little bit of support from monetary policy is warranted. The second aspect is inflation. Big dichotomy in inflation. Headline inflation is still much above RBI's target of 4%, but we are consistently seeing core inflation numbers to come off, which shows that monetary policy is working. But I suspect that till RBI sees actual headline inflation coming closer to its 4% mark, they will wait on rate cuts. And the third factor is financial stability side, which is a luxury to delve into when growth and inflation are fine. If growth inflation was not fine, we would have seen everyone talking about growth and inflation. But because we are cyclically in a good position, this is probably the right time also to build buffers. And maybe that's one reason why RBI might delay the rate cut. In Citi's house view, we think that the first rate cut happens only in October and not before that. But RBI has already ensured that the liquidity in the system has improved compared to the last 5 months. The overnight rates have come off, the short end of the rates have come off, the so-called stealth 25 basis point of rate hike that had happened, that 25 basis point of rate hike has been rolled back in some sense. So this is the first step of monetary policy easing, which RBI has already embarked upon. The second stage will be when RBI will be changing the policy stance from withdrawal of accommodation to neutral. Our sense is that somewhere in the middle of the year, and then with a couple of policies gap, we might actually see the first rate cut coming.